welcome everybody. Thanks for coming to the presentation. I'm Julie Wilkinson and the talk today is about how to grow by acquisition. So this is all about business acquisitions. I don't actually have a thing, so I'm going to have to use this. So just a bit about us. So I own Wilkinson Accounting Solutions and we are an accounting and consultancy firm. We specialise in business acquisition, so we help people grow by buying businesses, and we also help with exit strategy planning. So we help people, our overall aim is to help people transition from an owner-based sort of lifestyle business to an investor-based business, so it becomes a bit more of an asset. So effectively, either you can step away and it can run without you, or you can sell it in the future. We also do a lot of work for investors and pitch decks if you need funding for cash flows when you're buying businesses. So today we're going to talk about acquisitions. So has anyone done an acquisition? Sold a business? No? Looking to sell? Buy? No? Yeah. So what I'm going to talk today about is a little bit about why people grow by acquisition, and then I'm going to go through a bit of the process. We do about 5 acquisitions a month. I personally also buy businesses. We've got 7 CFOs that work with us, so we do this a lot. We do this in the UK and internationally. And so this is the stage of an acquisition. So the reason people might grow typically by acquisition is, one, it's quicker. You can often get good assets like employees, resources and things by sort of buying other people's people or employees. And it can also, if you merge, especially in tech world, we're seeing a lot. It can if you link up with your sort of what were competitors, it can give you a high customer base relatively quickly, so you can diversify and sort of grow into different markets. So when we look at the acquisition cycle, this is the cycle. I'm going to just talk through the stages. So it starts with deal structure and deal flow. So first of all, it's important to understand the industry that you're going into. There are a lot of courses out there these days that sort of say like no cash down deals, and we see a lot of people come in that don't really have any capital that want to buy businesses. Technically, you can buy a business with no money if you get the structure right. But I think it's important to have industry experience, because once you get it, you still have to run a business. So you have to then be able to run that business after. So what we say to people is we work with people a lot. We don't do deal flow. We're not brokers, but we are connected to a lot of brokers. And one of the things we say to people is think about how you're going to fund it and what type of deal. So we see. So when you get a lot of deals come through, someone will come to us and go, I need the business to pay for itself. So maybe they don't have any capital to put down. If you haven't got any capital, that's fine. But ultimately, you need the business to have a certain characteristic, because it's going to have a certain asset base on the balance sheet that's going to allow you to buy that business. So thinking about how you're going to fund the deal is really important right from the start, because I've seen people waste a lot of time and energy in deals that actually just aren't going to be right for them. Thinking about what cash you've got to invest. Do you need to get an investor, third-party funding, so that you can start those conversations going with the lenders relatively early? How many deals? So we do help people a lot build sort of internal plans. So if they say they want to do 10 deals, we'll look at, okay, so over the course of the deals, how can they reduce the amount of funding they might need? Because obviously we know with markets at the minute, funding is expensive. So people are trying to minimise that type of funding. And also exit strategy planning. So we do both. We work on exit and acquisition. And actually when people buy acquisition, they're not always thinking about the exit. But I always believe everybody at some point in time will want to exit. That might either be by illness, hopefully not, but it could be, by retirement, or maybe you just want it to run so you can do something different. So that's what we see about, when I think about exit, I just think me as a person, when do I want to do something different? So that's the sort of thing we'd be thinking at the point when you're looking for the acquisitions. So then you have your valuation. So typically businesses are valued on an EBITDA basis. So that is earnings before interest, tax, amortization, and depreciation. So basically profit before tax. That's how some are valued differently. So Minimum is normally like 3 times EBITDA. I know some companies, especially in the tech world, we've seen go for 10 or 12 times. But the multiples of EBITDA generally are based on sort of the commercial appetite for the buyer. So there isn't really a right or wrong multiple. That's down to you really of what you want to do. But there is an accuracy of the actual profit calculation in the first place. So it's normally done by the past 3 years. We find a lot that so actually they're usually done on adjusted EBITDA. So what people do is they adjust their profits for one-off income and expenditure that wouldn't happen again in the future. But you have to be really careful. I mean, I've seen businesses overvalued by way over $1 million just from adjustments that actually we wouldn't say were valid adjustments. And that's because generally people building them or looking at them don't really understand necessarily the commercial element of the profit and loss. They can see numbers, but they don't always know what it means. Then you have your balance sheet. So you can do deals in different ways. So you can do sort of debt-free, cash-free, which means you don't take any of the assets, but you don't take any of the liabilities. Or you can buy the balance sheet. So again, you have to be careful on sort of the valuation. And it's important to have those conversations early with the seller, in my experience, because what typically happens is I've seen businesses with about £1 million on the balance sheet, and when you take off the liabilities and the taxes, actually they're only left with about 300-400k. The problem is the seller thinks, oh, I've got $1 million, oh, it must be worth at least 800k. And then if you don't tackle that thing before heads of terms and you get far down the deal, it can cause sort of negotiation issues because they feel they're getting a bad deal. So it's just important really to make sure you're all on the same page at the beginning when you start. I think earlier on in the process, the better. So the earn-outs and profit shares, I think because of COVID, we've seen a lot of businesses are starting to try and value at the minute on future forecasts, because with COVID, they've maybe had a couple of bad trading years that they feel brings down the value from what the future opportunity is, which is fine. It's sometimes true, but then you have to be even more careful, because they say this, but they don't often have management accounts in place, forecasts to prove the earn-out. So what an earn-out would mean is you would pay a set value on acquisition, and then you would do some form of profit share after the acquisition. That would be in the share purchase agreement that you would then, over a period of 2 or 3 year deferral based on certain criteria that the business makes. So then you get to heads of terms. So heads of terms is a legal document. We don't draft them. Normally your solicitor would draft them. They're not actually legally binding, although elements of it are, so main being exclusivity. So the purpose of the heads of terms really is for the seller to say, yes, I'm happy with the high level terms, which is normally valuation and deal structure. So how much upfront are you paying, how much are you deferring? The exclusivity part is normally legally binding, so that means they can't then go and find other people to sell it to whilst you're in your exclusivity period. So it gives you time to do your due diligence, things like that, without wasting a lot of money. And often you'll have clauses in there to say if they do pull out or breach it, they'll have to pay for your fees because you would incur fees trying to buy the business. So the heads of terms is quite an important document. And I mean, I just did a deal. I closed, because I do my own acquisitions, I just closed the heads of terms last week and it took me 1 day. So I think if you are on board with the seller from the beginning, have good conversations, you can do it quickly. But I have seen heads of terms take about 3 months to get signed because really they've drafted the heads and they weren't really on the same page in the first place. So to me, I think it's all about alignment really. So then you have, so once you've done the heads of terms, you then go into due diligence. So ultimately the due diligence takes you all the way through to the share purchase agreement or an asset purchase, because you don't have to buy the full business, you can just buy assets of a business. So these are what we would say would be the full, the common due diligence you would do. So you'd have your legals, which your solicitor would do. And then us as a business, we help with the financial, tax and operational. There might be other due diligences, so maybe environmental, depending on the type of business. You might have a technical due diligence if you're buying some form of tech company. So there could be other ad hoc due diligences, but these tend to be the typical ones. So I won't really touch on legal too much because it's not my sort of protocol really, but financial, tax and operations, so what they mean. So the financial side for us would be, we would always say anybody buying a business wants at least a 5-year forecast, because most deferrals will be somewhere between 2 to 5 years. So you want to make sure that the business can actually afford it, the deferrals, and how are you going to fund that business growth. So financial due diligence would usually incorporate things like them giving you bank statements to verify numbers. It would give you, they would prove things like the last VAT return, has it been paid? So you'd get like financial information that would help you build the forecast. Ideally, you'd get some form of management accounts, because management accounts are different. So year-end accounts, I call them, so statutory accounts, are just sort of consolidated numbers for the whole year, and often they're condensed up, and so they'll add like cost centres together. Management accounts are more by cost centre level, so you get a lot more detailed trends, which is important. So like, as an example, we saw someone that had a business plan that said they had all this staff and it was a certain number, and then when we went to the profit and loss and checked the salaries number, it was 100k different. And then when we probed into that, it was actually they had a whole nother entity, and the 100k was in this other entity that they hadn't seen accounts for. So technically they're 300k overvalued already from the original information, because they didn't have the 100k of these other staff. So then they had to look at the other business. So that's where your financial DD would come in. The operational DD, I actually think, is one of the most important. The reason we do operational DD is because we think operations and finance have to link together. So the types of things we would try to gauge in operational due diligence would be what reliance on the business does the owner have? That's one of the biggest things, because I've seen businesses that have been bought where the owner sort of doesn't think they do a lot, and they're probably not lying, but it's just they do it day to day. And actually, when the deal goes through, I've seen operations drop by about 50%, because what was actually happening was the owner was actually fixing all the messes, so the teamwork wasn't performing. But I don't think they really realised that was happening. So I saw some deals where they hadn't really done any due diligence, and then this is the problem. So the operational DD would sort of indicate how quick can you grow the financial performance. So we'd be looking at things like, how do they quote for customers? Do they have trademarks? What systems do they use? What reporting do they have? All this type of information. And the reason we link it with the financials mainly is because when you're building a forecast, most people buying businesses have an appetite. They think, I could grow this 3 times over and things like that. They have a growth plan for it that maybe the current owners just don't want to do or can't do. And they'll often say, I can do it relatively quickly. So we've seen people with growth plans that say, in 3 to 6 months I can do this. But I've seen people that have put 3 to 6 month plans in, and it's taken them 12 months to even implement any, because if you haven't got any operations to drive that growth, it can't happen. And that's not a problem. It doesn't mean you wouldn't buy the deal, but what it does mean is you want your forecast to be realistic, because if you delay your strategies by 9 months, that can be a big problem, especially if you use the capital in the business to buy it in the first place. So that's why you really want the operational is, I think, actually key to the financial being delivered, because the financial is just past numbers. The operational is what's going to happen in the future. And then the tax due diligence, that can vary depending on the complexity of the deal. So, for instance, I don't know if people have heard of the IR35. I think that's been revoked now in the last budget, but for instance, if someone's using a lot of contractors, have they got contracts? And from should they really be employees? That would probably fall under tax DD. And just seeing have they had any VAT inspections, tax inspections, are they up to date with their taxes and things like that, because it can cause problems. I like real life examples, because I see about 100 balance sheets a month, so I see it all the time. So as an example, if bookkeeping information is poor, what we tend to find is accountants do a lot of year-end adjustments on the accounts offline that typically the business don't then put into their accounting software. The problem with that is when you run the trial balance from the system, it doesn't give you the right information. So things like taxes, deferred tax aren't often in there. And we know that people get payment plans and don't pay them. I've seen businesses with 3 years its taxes outstanding that aren't even on the balance sheet, and that can be I've seen that way over £1 million pound of unaccrued taxes. So tax due diligence would be, prove the tax returns, show me the bank statements where you've had the payments go out, so you can see they're paying them and things like that. Because otherwise you can get into some messy situations. So you've got the financial, the operational, and the tax. If you're doing the earn-out clauses that we talked about earlier, we'd be saying you want probably quite a good detailed forecast, because they would normally be based on some form of commercial performance that the business has to adhere to from prior sales or prior customers. Because obviously you will grow the business yourself and you don't want them to have the profits from what you've delivered. And actually, unless you have some form of detailed analysis in the workings, you wouldn't know what their earn-out clause would be based on. So there's a lot that goes into the due diligence, and I think sometimes people think they can do it themselves. They think it's easy, but in theory, getting some of the information is quite easy, but it's understanding that information and making sure that you've got the right clauses. So the legals draft the SPA. So when we do a deal for people, we will work closely with the solicitors. So we will say to people, if we find things that we think are a risk, we might say, I'd have a different warranty in the SPA to cover it, because if things creep up after the acquisition and you've got good warranties, you can knock it off the deferrals. That's the due diligence. So then deal close and business management. So the deal closes, and actually for me, I think this is one of the most important times for the buyer, because this is when the real work begins. So the deal closes. In due diligence, you can make decisions. We're seeing more and more at the minute where sellers and buyers are working together, because most businesses, like SME businesses, don't generally have good accounting ongoing within the year. They might get it at year end, but not so if you buy a business month 6 of their year, I would say 95% of people I see don't have any form of account. They might do basic bookkeeping. So if we see poor information, so poor bookkeeping, I think the worst I've seen is about 7 million on the balance sheet in wages, because they hadn't closed the P&L for about 5 years. That was interesting. But so things like that. So you have choices. So as the buyer, you either take a risk and you choose to have more clauses in the SPA and you go, or you say to the seller, we're seeing this more and more, I want someone to go in and fix the bookkeeping, get my management accounts sorted so that I can trust it before I buy it. And to be honest, we're seeing that a lot more, which I think is the better way, really, because nobody wants a bad deal. And actually, the seller can get a better value as well if you do that. So anyway, when you go live, depending on what you've seen in the DD would depend on, the first thing I would do is make sure my bookkeeping was up to date. So if they have poor bookkeeping before, then they probably haven't got anyone to do it after. So you'd have to think about, who do you get in place to do the bookkeeping? So then you have your KPI and operations. So where you build your 5-year forecast before, within the DD, you then break, I would say, at least the first 12 months down into some form of detailed KPI and planning, because businesses should be built on KPI. So this is how you then measure, because typical SME employees aren't generally measured that well, especially if it's been owner operated. So having the KPIs and operations is really important so that you can measure that going forward. Sorry, I've got a frog in my throat. So then financial reporting. So basic reporting would be at least a 12-week cash flow, a management account, and some form of BORPAC. I'm just going to check the time, sorry. And some form of BORPAC. So I don't mean a 15-page, nobody wants a 15-page BORPAC. I'm just talking about 2 pages of graphical data that will tell you how the business performs. And then you'd want to manage earn-outs and profit shares. So, if you have done earn-outs or profit shares in the SPA, then now you've got to be able to manage that, because there can be different agreements on profit shares. Maybe they get pre-debtors, or maybe it's on certain customers or certain projects closing. And ultimately, all of that has to come from some form of reporting. And if you have poor operation, so as an example, if you build a 12-week cash flow, so we help people build cash flows, but if the operational team don't manage projects, so they don't even know when they're going to close, then you'd be like, how do you know when to forecast the income? So that's why it's not just about having it, but delivering it. Ooh. So I'll do key takeaways and then some questions. So key takeaways are, I would save time by assessing the deal straight away, because you can waste a lot of time and effort on deals if they don't match your own structure. I'd say make sure you assess the accuracy of the EBITDAs, because I've seen a few things and they can generally be overvalued by a lot. I'd build at least a 5-year cash flow. from your due diligence. High level, I'd say pre, but detailed after. Do your operational due diligence. And then also, because we do have, I would assess the deal structure of how you want to buy it to minimise your tax. So that's basics. Any questions? Yeah, good question. So, how much would we charge? So the way we do our services is it's a stepped fee. So it depends where you need it. So at the beginning, we do have retainers of people, for instance, where we'll say, right, we'll assess 10 deals for you, and it will be like a fixed price, and it will be like 5 to 10 deals. The main due diligence part, we charge like a small deposit, and the balance is only payable if the deal closes. And then that depends on the deal size. It's minimum 10k, and then it goes up depending on the size. But it's only a minimal outlay from the buyer unless the deal closes. If the deal doesn't close, then we don't generally charge. Which team members? Okay. So for the operational DD, which team members would I recommend? I would say, well, it depends who they've got internally. So if they have a management team, so what we normally do is we actually have a call with the seller, because I find that's the best way to get the information, because you want to probe a little bit into the questions, because they'll say, someone will go to me, I don't do any finances. And then I'll say, well, who does the bank rec then? And then they go, oh, I do. So sometimes you have to probe into the questions to actually get the answers, because they don't always know unless they think about it. So, I mean, we do the operational due diligence with the buyers, and we would speak to sort of the key management team in the business. So, but that's then down to the seller of who they want, because they may not have told staff potentially, like it's selling. So it just depends really who the seller's willing to bring in on the calls. Any other questions? Oh.
Size of business do you normally deal with?
Okay. So size of deal. Generally, we work with businesses over 500,000 turnover. Independently, we work up to about 20 million deal. But we do often work with other finance teams and accounting firms on group deals. So for instance, someone will come and go, I want to buy a group worth 50 million. Which we do that, but we generally wouldn't do that independently because it's too much work, so we would partner up. But yeah, anywhere between sort of 500,000 and 20 million turnover. We could support lower than 500,000, but one, I wouldn't be recommending you buy them because they won't be run very well. And two, it can be quite costly as well. Any other questions? I think that's just about time anyway, so. Oh, well, thanks everybody.